What's going on, everyone? This is Jordan with Conquer Trading and Investing. In this video, we're going to take a look here at the S&P 500, dig into an overview, and share some analysis with you. Before we do that, let's start over here on this chart of the performance of the S&P in an economic crisis, because so far it does look like we're having a V-shaped recovery. Now, if you look over here, the red, this is the Great Recession going back to 2007, 2008. You could see that price did come initially down, come back up, and then once it tested into that resistance, it then not only made new lows, it continued to make a series of new lows before ending down 56.78%. Now, keep in mind, this bottomed in October, November of 2008, about a month or two before the Federal Reserve instituted quantitative easing. We have already instituted quantitative easing over here, so there is a big difference so far in these two. This is now also looking back here at the dot-com bubble. And you could see that we had first an initial down move, again up into resistance, and then price not only went on to make newer lows again, but a series of lower lows, also down 48, almost 49%, which is, 40-50% is generally the type of pullback you see in the equity markets during a recession. It could be up to 80% in a depression. Now, there again, this time, we have a couple of different factors. One of them is that we have not only the Fed has already gone ahead and instituted QE, but at the same time, Fed Chairman Powell has gone ahead and said that, he hinted on Friday that they're ready to go ahead and buy stocks of need be. That kind of helps put a possible floor in there. Not that a retest of the recent lows and or breaking them is out of question. Everything is on the table right now. These words were also shared on Friday by Fed Chairman Powell. He said, people are undertaking these sacrifices for the common good. We need to make them whole. Now, this is from some comments from Thomas Lee, an analyst from Vonstrat, and he did say that a close, which happened today over 2,800 for the S&P, is decisive. Now, logic says that there's tons of bad news ahead, and stocks are going to go down. Yet we can't tell the market what's to do. So a rally to now could have been a head fake, but the message of the market is that we're going to have a faster recovery because of the Fed put. So those are all things to consider. Let's look at the charts right now. And you can see we looked at during those whether it was the dot-com bubble bursting or the 2007, 2008 recession, we saw that price initially came into an area of resistance before rolling over, going on to make not only to retest the lows, but make a series of new lower lows. Whether or not that's going to happen this time remains to be seen. Everything is on the table. I do want to look here. Let me zoom down to the 1 hour just so you could get a better feel for what's going on, because we are now up into that resistance, but it gets heavy between 28.88 and 29.51. That also coincides with a couple of different things, all right? This horizontal resistance over here in this area, that's where if this move is going to have some trouble at this point, that's where it's going to meet some resistance and have the possibility of turning over. We're going to look at a couple of different scenarios here before we decide which one to go with. Now, the other thing that I want to see with you, let me move this over so that I could go ahead and look at some different time frames with you. I'm going to start on the 8-hour time frame. Now, the reason I look at the 8-hour time frame is a session of the S&P equity market is basically almost 8 hours, and it's not only that, it is a fantastic time frame to trade. And I'm just getting a bigger overview over here, and I see this trend line down over here. Now, a break of this trend line, because this at this point in this downtrend, this upward channel could be considered a bear flag, and a breakdown over there would lead open a test of the lows. Now, what else is going on over here? You could see that we have this trend line resistance over here. This is local resistance. It's not as strong as this one over here, and we're coming up into that as we come into the 28.88 level, which is going to provide possibly some resistance. And then if we are able to get over there, we have this trend line resistance along with this horizontal resistance at 29.51, and then ultimately the end of this. So there's still some decent move to the upside upside possible here. There's a lot of momentum. And yes, it's quite possible that because of the Fed's action, a bottom has been put in. So whether or not, a lot of people think that with the Fed going ahead and they're just printing an astonishing amount of money. We're up to right now $40 billion a day, which is greater than it was a week during the 2008 crisis, that this is going to have some adverse effects on the dollar. Now let's take a look at that. The IMF just came out and they do expect that the second quarter of this year will be when we see the peak of the panic. And they expect global growth in 2020 to be minus 3%. For some type of comparison, in 2009, it was minus 0.1%. Now, this is going to do is this is going to actually cause deflation. As there's less trade, you're going to see a strengthening in the price of the dollar. I do believe a lot of people are thinking that perhaps because of the amount of money being printed by the Fed, we're going to see actually a weaker dollar. And why that is possibly on the table, the thing you have to remember, whether we have a strong dollar or a weak dollar, both of those in these circumstances could actually benefit the equity markets. And the reason I say that is because obviously a weak dollar, being long equities, is kind of a play versus that weak dollar. At the same time, if the dollar does go on to break the 104 or 105 level and does that with authority, because of the dollar shortage around the world, the lack of trade, which is having people really having trouble getting a hold of dollars themselves, that could just cause further demand for the dollar. And if that happens, you might see foreign investments coming back into the U.S. markets in order to go ahead and take advantage of that strong dollar. So with the Fed put kind of behind the markets, and again, if we do wind up getting held up in this area over here of resistance, turning over and testing the lows, at that point, as Powell hinted on Friday, that's where he should come in and go ahead, and the Fed should start buying ETFs directly, which is absolutely crazy, but it is what it is, and you just don't want to stand in the way of the Fed. So whether or not this is going to be a V-shaped recovery, and we're going to head towards up 3,300, by the end of the year, early next year, that's too soon to tell. We don't know. We just know how the market's reacting right now, and the market is definitely pricing in that Fed put. So what does that mean? Well, either way, you have to realize that right now under these, this is a look at global reserves holding gold, right? And U.S. Treasuries. Now, this spike down in U.S. Treasuries, you have to understand this was because of dollar shortages. Countries needed to sell treasuries in order to get the dollars they needed to service the debt. Since then, the Fed has gone ahead and instituted a bunch of different, avenues to go ahead and derail that, including direct swap lines to the central bank. You're going to see in the months ahead less selling of treasuries. However, as the price of gold continues to rise, and it should, as the world's monetary is just continues to expand, you're going to see this also continue to climb higher. Now, here's a chart also looking here at Bitcoin, just to give you this overview of what happened after the first halving and what happened after the second halving, what happened. We are now not about 29 days until the third halving. And what do you expect is going to happen, especially with all the amount of stimulus being enacted in the world, the amount of stimulus still to come, as well as QE is just expanding the Fed's balance sheet at an unforeseen rate. And there's going to be a lot more of that. Now, whether or not the U.S. equity markets go up, well, that's one thing that we need to just, we'll continue to update you and take it as it comes. Right now, I expect some further extension into this area of resistance at 28.88, and then if we're able to break through, ultimately up towards 29.20 and 29.50, that's where we'll watch price closely to see if we're able to get rejected over there and then come back down and test the lower end of this channel again and see what happens down there, or whether or not we do break above. And if we break above at that point, then yes, 3,300 is in sight. So that's a quick look at the S&P right now. It's a quick look at some other factors that are really important, and getting down to it is with the expansion of the balance sheet taking place, gold is something that needs to be in your portfolio. You can see here as it is in global reserves across the world. Central banks are buying gold, countries are buying gold, and Bitcoin is in the perfect environment. The environment it was created for is about to enter that third halving I continue to be long gold, long Bitcoin, long the US dollars. And now I am, even though my logic tells me that we should be trading down towards the lows, I have to pivot a little bit here. And right now, continue to be long equities. I'm going to see what happens as we hit into this area over here. And I will keep you updated accordingly.